Escalation without restraint. Congressional rejection of war powers constraints signals a high-risk pivot toward unfettered military escalation in the Middle East. The Senate's decisive rejection of a war powers resolution to limit operations against Iran represents a critical inflection point in U.S.
foreign policy, removing a key legislative check on executive military authority. This action occurs against a backdrop of deepening regional conflict, including direct strikes on U.S.
assets and escalating proxy warfare, which has already injected severe volatility into global energy markets and sovereign debt instruments. The political calculus suggests a strategic alignment within the Republican congressional bloc to prioritize a posture of maximum pressure over diplomatic de-escalation, effectively betting that overwhelming force will deter further Iranian aggression.
This unambiguous shift toward a less constrained conflict framework dramatically increases the probability of a broader regional war, with immediate implications for risk asset repricing and long-term geopolitical stability.
The geopolitical powder keg. The legislative move is not an isolated event but a deliberate escalation within a pre-existing high-stakes confrontation. The current conflict is rooted in the collapse of the JCPOA framework and a subsequent cycle of provocations, including Iran's accelerated uranium enrichment and support for militant groups across the region.
The U.S. responded with a campaign of targeted strikes and stringent sanctions, creating a fragile status quo of managed hostility.
However, the rejection of congressional oversight dismantles a primary mechanism for conflict modulation, effectively granting the executive branch carte blanche for military operations. This occurs as Iran itself approaches critical nuclear breakout timelines and key regional actors like Israel and Saudi Arabia adjust their own strategic postures.
The underlying driver is a fundamental belief within the prevailing Washington policy circle that Tehran only responds to demonstrated force, a theory now being tested without a legislative safety net.
Markets on a knife's edge. Financial systems are now forced to price in a sustained, high-intensity conflict with no defined off-ramp, triggering capital flight from emerging markets and a rush to hard assets. The immediate market reaction has been a classic flight to quality, buoying the U.S.
dollar and treasury bonds while hammering equities and currencies in conflict-adjacent economies. The more profound structural risk is the threat to the Strait of Hormuz, a choke point for roughly 20% of global oil consumption. Any sustained disruption would trigger an inflationary supply shock that central banks are ill-equipped to combat.
Furthermore, the sanctions regime will intensify, complicating global trade finance and forcing multinational corporations to navigate a fractured compliance landscape. Defense and aerospace sectors are poised for significant re-rating as budgets expand, while traditional growth stocks and IPOs face severe headwinds from rising discount rates and risk premiums.
The volatility index term structure is likely to invert, signaling trader expectation of prolonged instability.
A forecast of controlled detonation. The strategic verdict is a high-probability path toward a managed but persistent war with containment as the operative and optimistic scenario. The most likely projection is not an all-out war but a protracted grey zone conflict characterized by deniable strikes, cyber warfare, and economic attrition, all conducted under an elevated threat of conventional escalation.
This environment creates a persistent risk premium across asset classes, particularly for energy commodities and geopolitical risk-sensitive equities. Strategic next steps for institutional investors must include stress testing portfolios for stagflationary scenarios and diversifying into non-correlated assets, including certain digital currencies perceived as hedges against sovereign instability.
The critical unknown remains the threshold for Iranian retaliation that would force a full-scale U.S. military response to a red line that is now ambiguously defined.
The ultimate consequence is the solidification of a new, more dangerous epoch of great power competition, where financial markets' ability is permanently coupled to battlefield developments.